I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Do you know that $100 can only buy 93% of what you could buy 12 months ago? The signs of recession are already here. You are watching this video because you want to know what is coming, and you have come to the right place. Jeremy Grantham is famous for his predictions because he has a track record of accurately predicting major market events. He gained recognition for accurately predicting the dot-com bubble in the late 1990s and the housing bubble in the mid-2000s. These predictions were made well before the events and helped investors navigate turbulent times. Grantham's ability to foresee significant market shifts has earned him a reputation as a highly respected and influential investor. So, why does he think something worse than recession is coming? Here is why. The market attention deficit. Jeremy Grantham, the co-founder of GMO, a global investment management firm, has been a prominent figure in the financial industry for decades. In recent years, he has expressed concerns about what he calls the market attention deficit and its potential consequences. Before we delve into the details, let's define what Grantham means by the term market attention deficit. According to him, it refers to the tendency of investors to focus on short-term market trends and overlook long-term fundamentals. This behavior can lead to excessive speculation, mispricing of assets, and ultimately, economic instability. Grantham argues that the market attention deficit is fueled by the increasing prevalence of short-term thinking among investors. In today's fast-paced world where information is readily available and markets react swiftly, investors often prioritize immediate gains over long-term sustainability. This short-term mindset can distort market valuations and create asset bubbles. One of the key concerns raised by Grantham is the formation of asset bubbles. When investors become fixated on short-term gains, they may overlook the actual value of assets, leading to their overvaluation. This can create a bubble that eventually bursts, triggering a market correction or recession. Grantham emphasizes the need for investors to adopt a long-term perspective. By focusing on the underlying fundamentals of the economy and companies rather than short-term market fluctuations, investors can make more informed decisions and reduce the risk of contributing to market instability. Grantham also highlights the role of central banks in exacerbating the market attention deficit. Central banks often implement monetary policies to stimulate growth in response to economic downturns. However, these policies, such as low interest rates and quantitative easing, can encourage excessive risk-taking and further amplify short-term thinking among investors. Jeremy Grantham's insights on the market attention deficit shed light on a crucial aspect of the financial world. As investors, it is essential to recognize the potential risks associated with short-term thinking and the formation of asset bubbles. By embracing a long-term mindset and considering the broader economic landscape, we can contribute to a more stable and sustainable market. Potential S&P 500 crash. Jeremy Grantham is a well-known investor with a reputation for predicting market bubbles and crashes, and his latest warning is about the S&P 500. Grantham believes the S&P 500 is currently in a bubble, fueled by low interest rates and excessive liquidity from the Federal Reserve. He argues that the market is overvalued and disconnected from the real economy, which is still struggling due to the pandemic. According to Grantham, the S&P 500 will likely crash by 50% or more shortly, which could trigger a recession. He points out that previous market crashes such as the dot-com bubble in 2000 and the housing bubble in 2008 were followed by recessions. Grantham also notes that the current market bubble differs from previous ones as a particular sector or asset class does not drive it. Instead, it's a broader-based bubble that affects almost all stocks, including those in the tech sector, which have been driving the market's recent gains. Grantham's warning is not just based on his intuition or experience. He has conducted extensive research on market bubbles and their aftermaths, and his analysis suggests that the current market conditions are unsustainable. Furthermore, Jeremy Grantham believes a potential S&P 500 crash could bring a recession, given the current market conditions. While his warning may seem alarming, it is essential to remember that market crashes and recessions are not uncommon in the stock market's history. As investors, it is crucial to be aware of the risks and to have a diversified portfolio that can weather market turbulence. Tech bubbles. Before we discuss Jeremy Grantham's perspective, let's first understand what a tech bubble is. A tech bubble refers to a rapid and unsustainable increase in the valuation of technology companies, often driven by excessive investor optimism. These bubbles tend to occur when investors overlook the fundamental value of these companies and instead focus on short-term gains. Jeremy Grantham, a highly respected investor, has warned about the potential risks of tech bubbles. He argues that these bubbles can lead to a significant economic downturn, even a recession. Grantham believes that the current tech bubble is fueled by excessive speculation, reminiscent of previous market bubbles like the dot-com bubble of the late 1990s. Grantham points out that many tech stocks are trading at extremely high values, often disconnected from their underlying fundamentals. He argues that this overvaluation creates an unsustainable environment where investors are willing to pay exorbitant prices for companies that may not be able to deliver the expected returns in the long run. According to Grantham, when the tech bubble bursts, it can have far-reaching consequences for the broader economy. The collapse of overvalued tech stocks can lead to a loss of investor confidence, triggering a chain reaction that affects other sectors. This loss of trust can result in declining consumer spending, business investments, and overall economic growth. Moreover, he draws parallels between the current tech bubble and previous market bubbles such as the dot-com bubble and the housing bubble. He emphasizes that these bubbles were characterized by euphoria, irrational exuberance, and a disregard for traditional valuation metrics. Ultimately, these bubbles burst, causing significant economic downturns. So, Jeremy Grantham should advise investors to exercise caution and not get caught up in the hype surrounding tech stocks. He suggests focusing on long-term value and fundamentals rather than short-term gains. Interest rates. Before discussing the investor's perspective, let's briefly understand interest rates and why they matter. Interest rates are the cost of borrowing money set by central banks to control economic activity. They influence various aspects of the economy such as investment, consumption, and inflation. According to Grantham, interest rates play a crucial role in determining the economy's overall health and can potentially trigger a recession. He believes that when interest rates are too low for an extended period, it can lead to excessive borrowing and speculative behavior. Grantham argues that prolonged periods of low interest rates can create asset bubbles as investors search for higher returns. This behavior can lead to overvaluation of assets such as stocks and real estate, which eventually burst, causing significant economic downturns. Grantham warns that these bubbles can become unsustainable and ultimately result in a recession. Another aspect Grantham highlights is the impact of low interest rates on the business cycle. He suggests that when interest rates are kept artificially low, it can distort the normal functioning of the economy. Businesses may become overly optimistic, leading to excessive investments and potentially misallocation of resources. Grantham argues that this can create economic imbalances, eventually leading to a recession. While Grantham acknowledges that central banks often lower interest rates to stimulate economic growth during challenging times, he emphasizes effectively monitoring and managing these rates. He suggests that central banks should be cautious about keeping rates too low for too long, as it can have unintended consequences. Summarily, Grantham's insights serve as a reminder of the potential risks associated with prolonged periods of low interest rates. It is crucial for policymakers and investors to carefully consider the consequences of their decisions to maintain a stable and sustainable economy. Human behavior. With his extensive experience in navigating market cycles, he has observed one common element that triggers recession: human behavior. Grantham argues that understanding this crucial aspect is vital for avoiding future economic crises. He believes in the concept of irrational exuberance, highlighting how human behavior often leads to over-optimism during periods of economic growth. This unwarranted confidence leads to asset bubbles such as the dot-com bubble in the late 1990s or the housing bubble in the mid-2000s. When people become excessively optimistic about investments or economic prospects, they ignore fundamental principles of valuation and risk. This behavior eventually creates an unsustainable situation, setting the stage for a severe economic downturn. When the market is on an upward trajectory, individuals perceive gains enjoyed by others as indicators of an opportunity. This herd mentality further amplifies the risk of a recession. For example, during periods of market exuberance, people's decision-making becomes increasingly influenced by the actions and opinions of others. This collective behavior can push the market to unsustainable levels, leading to an eventual collapse. Another aspect of human behavior that contributes to economic instability is short-term thinking. He argues that individuals, including both consumers and investors, often prioritize immediate gains over long-term sustainability. Summarily, Jeremy Grantham's insights shed light on human behavior's critical role in triggering recessions. By recognizing the dangers of irrational exuberance, herd mentality, and short-termism, we can take steps toward building a more stable and resilient economic system. Individuals and investors must remain cautious, maintain rationality, and prioritize sustainable actions to avoid being caught in the vicious cycles of recessions. Bubbles.
I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly.
Before we begin, let's briefly understand what a bubble is. In economics, a bubble is when an asset's price becomes greatly exaggerated and disconnected from its intrinsic value. Speculative buying typically fuels these bubbles and can occur in various markets such as real estate, stocks, or commodities. Jeremy Grantham has been studying and analyzing bubbles for decades. He views them as an inherent part of the market cycles and believes they can significantly affect the wider economy. According to Grantham, bubbles tend to foster an unsustainable overvaluation of assets, which, when left unchecked, may pave the way to a potentially catastrophic recession. Several contributing factors lead to the formation of economic bubbles. One crucial factor is excessive optimism driven by the belief that asset prices can only increase. This mindset usually creates a snowball effect as more investors rush to buy into the asset, further inflating its price. Another factor Grantham highlights is financial innovation and complex financial products. These innovations often amplify the risks associated with the asset, making it difficult to evaluate its true value accurately. Over time, this can exacerbate the bubble's formation and increase the potential damage it can cause. Eventually, when a bubble finally bursts, it triggers a domino effect of widespread financial distress. The sudden drop in asset prices leads to a significant loss of wealth, thereby reducing consumer spending and business investment. This contraction in economic activity ultimately results in a recession. Additionally, we must emphasize that excessive debt accumulation during the bubble phase worsens the recession's severity. As asset prices decline, borrowers face difficulties repaying their debts, leading to defaults and a tightening credit environment. This further amplifies the economic downturn, prolonging the recovery period. Ultimately, Jeremy Grantham's perspective on bubbles and their potential to trigger recessions adds an exciting layer to our understanding of market dynamics. While some debate the certainty of future bubbles and their consequences, it is essential to remain aware of the risks associated with excessive speculation and unsustainable market conditions. How do you beat what is coming? There is an overwhelming sign that a recession is coming. For example, the recent collapse of the Silicon Valley Bank and other financial crises show an impending economic downturn. So, how can you beat this incoming economic doom? Let's quickly discuss them. The obvious step is to know where to invest your cash since we can't trust banks anymore. Identify defensive sectors. Investors must focus on what the billionaire investors call defensive sectors, which tend to withstand economic downturns better than others. These sectors include utilities, healthcare, consumer staples, and energy. These industries serve basic human needs, providing resilience even in tough times. High-quality dividend stocks. Dividend stocks are shares of companies that regularly distribute profits to shareholders. Grantham says investing in high-quality dividend stocks can provide a steady income stream during a recession. Look for established companies with constant dividends and solid financial fundamentals. Bonds and Treasury securities. Bonds and Treasury securities are considered safer investments during a recession. Grantham suggests allocating a portion of your portfolio to the government or corporate bonds, as they provide fixed interest payments and can protect against significant market declines. International diversification. Jeremy Grantham emphasizes the importance of international diversification. In uncertain times, spreading investments across different countries offers added stability. Investing in developed and emerging markets with strong economies and industries can lower exposure to the negative consequences of a single market's downturn. Long-term investing approach. We advocate for a long-term investment approach. Trying to time the market during recessions is challenging and often counterproductive. By remaining patient and maintaining a disciplined approach, you can benefit from the eventual recovery and potential growth after a downturn. Monitoring and rebalancing portfolio. Regularly monitoring your portfolio is essential to ensure it aligns with your investment objectives. Grantham advises investors to periodically rebalance their portfolio by selling overperforming assets and buying underperforming ones. This approach keeps your investments in line with your risk tolerance and long-term goals. And there you have it, Jeremy Grantham's insights on factors that will trigger an incoming recession. Also, we discussed how to invest and secure your finances against recession. We hope you found this information valuable. If you did, don't forget to give us a thumbs up and share this video with your friends. Stay tuned for more informative content, and we'll see you soon.